And welcome to Health Service Management 308 Healthcare Finance. Ladies and gentlemen, this is a short chapter, and we are experiencing some heat in the building today. The air conditioning is broke, and it is rather warm in here today. So we're probably going to have just a short lecture. We are discussing Chapter 13 today, the time value of money. As a manager, you have many options as to where your resources of the organization should be spent. And understanding the different types, of calculations that will help provide as a guide to you in being able to determine how to allocate your money. Helps you to make very informed choices as to where you want to spend that money. There are 4 specific types of computations that you as a manager will evaluate, and they are the unadjusted rate of return, the present value analysis, the internal rate of return, and the payback period. I'm going to try to get our PowerPoint on a slideshow so it will be a little more viewer friendly for you. Whenever we are looking at our unadjusted rate of return, this is a return that is relatively simple, yet we do need to keep in mind that it is only an estimate. The original, we need to keep in mind that the original investment amount is generally a matter of record. I'm trying to find, or I should say work forward here. There are practice exercises in the back of your book. I'm going to see if I can get up to, here we go. This is okay. These are okay, maybe I should just leave it as it is. Okay. This particular method is sometimes referred to as the accountant's method because all of the information that's required to obtain for this is found on the financial statements. Your unadjusted rate of return computation is as follows. And you can read this, but let's go ahead and look at your example here. You will assume, under your assumptions, that the average annual income is $100,000. And the original investment amount was $1 million. Unrecovered assets, which is your salvage value, was $100,000. So when you're calculating that, you're going to use your original investment amount, which was $1 million, divided into to get the salvage value, which is going to give you a 10% unadjusted rate of return. Because if you remember, it is always calculated in percent and reported in percentages. First of all, now we just read that, but you're going to, the first thing you're going to do is compute your average investment. We know that was $1 million. Useful life was 100,000. The sum was 1,100,000 divided by 2 gives you an average of 550,000 average investment amounts. You can see there are lots of different examples there for you to look at. I want to draw your attention to the back of the book where your examples are that will allow you the time to examine those and go through. And most of you, I think this is a review for some of these unadjusted rates of return. Your present value analysis, this is based on the time value of money. The value of $1 today is more than the value of $1 in the future. And that's how we derive with the terminology of present value. And the longer we go, that value is going to be what it's actually less worth. Worth less. I said that backwards. It's worth less. You know, if you think about it, and to bring this in perspective, $1 2 years ago will buy more, or would buy more than $1 will buy today. $1 10 years ago was worth a whole lot more money because it would buy more than what it will buy today. Therefore, you can see how that value of the dollar and how it's worthless. This is the concept of our present value analysis. Whenever you are looking at this present value analysis, we need to understand that it's possible to use equations to restate that present value of $1 to be paid out, or it may be money coming in. But the present value tables can take the place of that equation. We don't necessarily have to calculate it. We can actually use a business calculator to compute that as well. And in all reality, you can use your textbook, your computer, to be able, with a function on your spreadsheet, in your Excel spreadsheet, to be able to produce these factors. But no matter which method you use, the same answer should be derived from it. So let's look, because these value tables are included at the end of this chapter. So if we look at a present value, the present value table, and that is on page 141, we can actually look up. So let's go and look at, you can see how it's set up. You've got your years on the left-hand side. And actually, this goes over on to, goes up to year 30 years, excuse me. And let's say that we were looking at it on 10%. 10 years at 10%. We would go down to the year 10, and we found the 10%, and we slide over there, and where the two intersect, we can see that it is at 0.3855. Now, we can see right there that the present value of $1 under the 10-year and 10% is about 38.5 cents. Now, we could from that, we can go and find, since we have our present value of the dollar, it's fairly simple to find the present value of any number. Because then at that point, you are just going to multiply the other number by the factor that you found in the table. If you wanted to find the present value of your textbook gives you this example of $8,000. Under the assumption that we used on the 10-year 10%, you would just simply multiply that $8,000 by the factor that we found in the table, which was 0.3855, and that would result in the present value of $8,000 is $3,084, or 8,000 times 0.3855. If we were going to be looking to do the compound interest table, this is also included in the chapter in Appendix 13, in addition to showing the present value of an annuity of $1. And that appendix is in 13C. Those tables work the same way. So let's talk about the internal rate of return. This is another return on investment method, and it is used and uses a discount cash flow technique. This discounts future net inflows from your proposed investment, right down to the amount invested. Your internal rate of return actually recognizes the elements that are contained in the previous two methods that we just discussed, but yet it goes a step further. Your internal rate of return recognizes the time pattern in which the earnings occurred, and it's going to give you a more precision in that computation, because the internal rate of return is from period to period, whereas the other two methods are purely based upon an average investment. So your internal rate of return is not real complicated. It requires two assumptions and three steps. The first assumption, let me find my PowerPoint here. Is your first assumption is the initial cost of the investment. The second is the estimated annual cash flow. And three, you have to find the useful life of your asset, and that needs to be expressed in the number of periods. So during step one, you are going to divide your initial cost of the investment by the estimated annual net cash flow. And remember, you're going to report this in a ratio. Then you can go to your lookup table, as we talked about earlier, and find the number of periods. Then find your column that is going to approximate the ratio that you computed, and you'll fill in that column that is the interest rate that is going to reflect the estimated or approximate rate on your return. And then your internal rate of return can also be calculated through equations or through a series of steps on a business calculator. And the PowerPoint does have examples here for you. You know what your initial cost is, what your estimated cash flow from the investment is, what you estimate that to be, and your useful life assets is 10 years in this example. Then you take your initial cost of $16.950, and then you're going to divide it by the estimated annual net cash flow, which was $3,000, and then your answer in percentage, your ratio is 5.650. Then you're going to look up, then you're going to use your tables and go from there. And here's another example. So let's talk about the pay period or payback period. This is the length of time that is required for the cash coming in from your investment to equal the amount of your original investment. How long did it take you to make that money back? If I invested $10,000 into a business, how many years is it going to take for me to be able to get that $5,000 investment back? Your payback period concept is used extensively in evaluating whether to invest in plants, equipment, so forth and so on. And whenever you're able to computate um, what you project being your payback period, and of course you always want to do under the best case scenario and the worst case scenario, uh, to enable you to be able to make this judgment call. So your book gives you a couple of really good examples on how to calculate through a couple of methods here to determine whether an investment would be good. We have Dr. Green is considering the purchase of a machine for his office lab, and that piece of machinery costs $3,000. And he wants to find the payback period for this piece of equipment. So to begin with, he has to make some assumptions. Again, here we are making those assumptions, don't we? And the first thing he's identified was the price of the equipment. That was $3,000. Then he has to determine the useful life of that piece of equipment. And let's say that was 10 years. And the revenue the machine will generate per year after taxes, we're going to say is $10,000. And the direct operating cost that's going to be associated with earning this income, we're going to say is $150,000 with a depreciation expense per year of $3,000. Now that he has all of that determined, now what do we do? Well, your exercise on your PowerPoint shows you something different, some different figures than what is in your textbook. Well, this is a different one. So we're just going to use the textbook as we are walking through here. Now that all of these assumptions are in place, it's time to calculate the payback period. And there's 3 steps to it. The first step is you're going to find the machine's expected income after expenses. And that was assumed from number 3 under the revenue. They figured it was going to be $200,000 less the direct operating cost of $150,000. And then they have to take the depreciation into play there. Then your net income is $20,000. Your net income taxes or less income taxes, excuse me, of 50%, which was $10,000, which left a net income after taxes of $10,000. So you can see that the net income after taxes matches the revenue the machine will generate after taxes. It balances there. The next step is you want to find the net annual cash flow after taxes the machine is expected to generate. And you can read through that and follow along how they have derived at their payback computation. And basically, they have determined that the machine will pay back its investment in about 7.5 years. And anytime that you are purchasing equipment, you definitely want to do this because you want to be able to determine how long you are projected to have this extra expense in comparison to the generated revenue that it will bring in. I can remember when my father-in-law was in business. He owned a dry cleaning business in Blacksburg. And he sold off a lot of his assets and went into business. And he had his 5-year business plan. And all of the equipment, his return on investment with his property and all of his equipment was, his goal was to have it all paid within a 5-year period to where he was looking at profit dollars. So that took a great deal of computation in many different areas in order to calculate that, but he was successful with that. The property that he had purchased also had a house on it. And, you have to realize that they had sold their home and moved along with all of their other assets. And that property, you may be thinking, oh, okay, well, they just lived in the house there on the property beside of the dry cleaners, but they didn't. What they did was they rented the house, which generated income, which was money put back into the business. And the business was large enough that there was a large enough area in the back where they had a living room, a kitchen area with a table, a bedroom, and a bathroom. And that's where they lived until their initial investment had returned. Their payback had returned. And at that point, Dad had one other piece of property that one asset that he had held on to that he always kept separate from anything else. And at that point, he sold that, and he was investing his property, setting back his capital money, and then he was paying himself a little bit over and beyond that, and he built my mother-in-law her dream home. So you can see how he planned that out in a 5-year period. We need to do this in the healthcare facet as well. When we are looking at purchasing a piece of equipment, if we're looking to purchase an MRI machine, we've got to look and see what that investment is. Are we going to be able to generate enough business over and beyond our normal clientele because this piece of equipment is going to attract a certain patient population? Is the increase in that certain patient population going to offset and enable us to be able to make our money back within a reasonable period of time? And honestly, a good rule of thumb is to be able to have your return on investment collected prior to or at least at the end of the useful life of that piece of equipment. Ideally, you'd love to have it before that, but a lot of that's going to depend upon the actual cost of the piece of equipment. Ladies and gentlemen, I want you to review over this chapter. Your question embedded in this lecture is what is the purpose of the various computations to determine the value of your money? And why is this, I think I said this, why is it so important to you as a manager? That is going to conclude our review of this chapter, because I know, like I said, that a great deal of this is review, and we've got just a couple more chapters to review, and then we're really going to get into some of the nitty-gritty of the health, how all of this is going to begin to apply in the field of healthcare. Hope everybody has a great day, and we will cover chapter 14 during Friday's lecture.